For a look at the economy following last week's PCE report, to join us right now is Carlyle Head of Global Research, Jason Thomas. Good morning to you, sir. I think we're all trying to figure out where we really are. So where are we?
Well, I think when you look at the PCE report, I think the first point to make is that the Fed has not hit its inflation target in now 54 months. That's quite a long time. There are about 3 million children who are enrolled in elementary school in the United States who have been born since the Fed last hit its inflation target. Just to put that in perspective.
So this is, you're in the indictment camp of the Federal Reserve.
No, I think that the length of time is something that we should appreciate. Secondly, very often you hear people say 3%, 2%, what's the difference? But I think we should appreciate that this excess inflation we're observing today is coming on top of what has already been a 20% increase in the consumer price level. So, this is, I think there's a callousness to trivializing excess inflation at this point, again, given how much the prices have risen.
Why do you say it's being trivialized?
Well, I think that there's, of course, push for rate cuts.
Right.
And there's measurement errors. Or, again, if it rounds to less than 3%, if it's just 2.9% on core PCE, it's very often you'll hear people say it's 2 and change, to sort of imply that we're really much closer to the 2% target than we are. And of course, we spend so much time talking about tariffs. Tariffs only cover, slightly less than 20% of the categories in the PCE index.
Okay, so what do you think is driving all this then? So you don't think, so you're saying tariffs are not the problem?
No, I don't think that's reflected in the data. For example, services unaffected by tariffs continue to increase at a 3.5% annualized rate. That's about 125 basis points from where it was prior to the pandemic. You have the super core, of course, that the Fed supposedly focused on very closely. That's still at 3.3%. Most recently, it was the highest since February.
So are you suggesting they should be raising rates? Is that what you're trying to say?
No, not at all. But I think that this asymmetry, that the next move in rates is down, and the speed with which rate cuts will come. This seems a little aggressive given where we are in the broader inflation. A little
aggressive to have one cut is all we've seen at this point, though. And
sure.
Chairman Powell said that this is a risk move to make sure that we're not missing it. So your expectation is maybe they ratchet things down from here?
I think that they should take some time and digest this. I think also, in many ways, you have two big policy shifts. Of course, tariffs. Mm-hmm. But then also border enforcement, broader immigration. In both cases, you have what is equivalent to a supply shock, negative supply shock. To the extent that you're actually cutting rates, you're accommodating that, perhaps making it easier to raise prices, perhaps having upward pressure on wages. So I think, again, allowing the economy to absorb this new reality, find a new equilibrium, is probably the path that would be more consistent with the price stability goal of the Fed.
So at this point in the ballgame, not what you think should happen, what do you think will happen over, let's call it, the next 12 months?
Well, I think that the idea that the Fed should be cutting aggressively in the face of what is the largest concentrated CapEx boom in at least 25 years, strikes me as inapt.
Right.
So again,
I should say that's coming from a private equity firm that typically likes low interest rates. Well, right. So what do the folks at the firm say about all this?
Well, no, I think low rates would be fantastic. But the idea, I think, is that you want low rates to come in the context of inflation that's back to target, because that is what is going to really have a sustainable decline in rates, not just short rates, but also pulling down on the long end of the curve. If you're too aggressive, if you move too soon, you may actually have an unwanted upward move in yields, as we saw last year. You cut by 100 basis points, and then you had what was equivalent to a 100 basis point rise at the long end of the curve. You don't want that to happen again.
Throw in unemployment into this picture.
Well,
because that's a big piece, it sounds like, what's driving Jay Powell's thinking.
Sure. I think that, again, it's a question of, you have right now, you have a inflation target, 2%. Again, I don't know how seriously that's taken, but that's there. You have a maximum employment goal. At some point, there also may be a third objective for the Fed, which is to help stabilize public finances. I think that is, people talk about Fed independence. One person's independence is another person's unaccountability. These are sort of word games. But what I do think we're going to see over the next couple of years is the incorporation of a third target. So right now, you have the employment that is a maximum employment goal that is a reason to keep rates lower. And eventually, we may also have concerns about public finances, just lower interest rates paid on the debt. That is another reason to keep rates lower.
So I get all of that. But what I guess I'm stuck is it sounds to me like in a perfect world, you would actually raise interest rates.
No. I think, again, right now, when you look at forward curve, you have an expectation that rates will fall to 3% by the end of next year. Again, that doesn't seem consistent with this CapEx boom that we're observing.
Right.
You have unemployment that is 0.1% away from what the Fed considers its target, 4.2% in the S&P. So this just seems to be an environment where rates closer to 4% than 3% is what would be more
Can I throw
natural.
out one last thing? I know we're going to run out of time. What happens if the tariffs are deemed to be illegal?
I think there's lots of other statutory authorities the president possesses that you can make reference to those. So, I mean, there's a question of rebates. There's a lot of complexities. But I do suspect that the president will be able to, 1962 Trade Act, 1974. So this is a question.
There's things he could do for 15 months at a time, and
and roll it over. And
you just say roll them forever. It could just roll forever.
I think that the president is vested with really extraordinary and broad authorities when it comes to the ability to impose tariffs. And I think people shouldn't get too excited if the 1977 Act is ruled to be inapplicable for this
and a lot of the
specific
tariffs
set
he's
of tariffs.
doing now are under these special sectors, like considerations for.
That's right.
Right.
Exactly. And so, again, I think
kind of shifted their policy attack on
people shouldn't get too excited if these are struck down because there's other avenues, other mechanisms.